Hi everyone, this is Demo Gonzalez with Heartwood Financial Services for the May market update. Thanks for tuning in. Hope you enjoy it. Should be a good one. So here are the asset class returns for the end of May. And you might notice now that real estate is now on the top of the heap. It was doing pretty well, about third up, but it's one of the few areas of the market last month that was up. Large cap stocks still up over 10%, but down quite a bit from where it was at the end of the month of April, which was about 18%. So it's down close to 8%. Small cap stocks as well, down pretty good. Still up about 9% for the year. Domestic market equities also down. Pretty much everything was down except for real estate and the fixed income. Asset allocation portfolio at 7.6%, so that's down about 4% from last month. High yield down about 1% or so. The fixed income at 4.8, still looking pretty good. Got about 2% growth in the month. Emerging market equities down a little bit, but again, nicely still positive for the month or for the year. Commodities kind of in the same place here, and cash as well. So as you could see, not a lot of things did very well last month except for real estate, cash, and bonds. Okay, so here's one of my favorite slides, the math behind the S&P 500. So I always like to start with this. This shows, as of today, the earnings numbers really haven't changed very much. Last month, if you recall, the growth for the S&P 500 in 2019 was around 3%. So that really hasn't improved any. And the price that we have as of just a moment ago on the S&P is 28.77. The average PE for the last 25 years is 16.2. So if you do the math of 167 times 16.2, you get about 2706, which makes us a little bit above right now of where the market should be valued based on earnings. So when you include the dividend, we should probably see a small negative return for the rest of the year. Now, why is the market priced this way? Well, a couple things. Maybe the trade wars are going to be resolved, and that's going to help earnings. I'm optimistic, but a lot of things have to go well, I think, for that to happen. As you see, recently things have actually gotten a little bit worse in that department. The other thing that could happen now is maybe this PE ratio could go up. And that PE ratio can go up if interest rates go down. It's kind of like a multiplier for the PE. That is also kind of up in the air, so we'll see. There are signs that that could happen, and that could justify this higher price today. So we will certainly be watching for that, and more to come. So where are the leading indicators now? So if you guys remember this chart from before, the top part of this of the quadrants showing growth, the right side is expansion of growth, and the left side decline of growth. And most of the leading indicators are still in a growth category, but they are in the declining area. This red little square shows kind of where the aggregate of all of it is. And so this is pretty much the same spot it was last month. So what we're seeing here is there's not much of a change in the leading indicators. They're staying pretty much neutral. Although I would add that since the 31st of May, there's been some recent reports that have come out slightly negative. The PMI globally starting to show a little bit of a slowdown. The manufacturing numbers are starting to look a little bit weaker for the recent month of June. And as of today, there were unemployment numbers that disappointed a little bit. Again, still pretty good, but not getting better than they were from the end of the month. Another interesting phenomenon, as you can see here, is yields have been coming down. The gray dots here show where interest rates were about 6 years ago, and the blue line is where they are today. Now the important thing to think about is, why are interest rates going down? Well, interest rates go down when more people are buying bonds. And why do people buy bonds? Well, they're maybe a little nervous about economic growth. That's why they've been buying bonds. So what we're seeing here is a development that the bond market is telling us that maybe the economies of the world are slowing down. And so that is something to definitely keep an eye on. The other interesting thing here is on the short end of the yield curve, which is what this whole line is. It's actually higher than it is on the longer term rates, even all the way to a 10-year. So this is what's called a yield curve inversion. This is also a very ominous sign for the economy. Usually one of two things will happen when you see a yield curve inversion like this. Either the Fed will have to cut interest rates to make it look more like this, and they only cut the short-term rates, or we're going to go into a recession and these are going to go back up. So right now the Fed has been mostly pricing in, or the market I should say, been mostly pricing in that the Fed is going to lower interest rates. And what we've seen in the last week or so is the market reacting very positively to that. It's not a done deal though, because if the trade negotiations go better, interest rates could go back up again. If they don't and growth continues to go slow, they might be forced to cut rates. So this will be a very interesting development to keep an eye on. It affects money market rates, it affects loan rates, mortgages, all kinds of things. So Demel, why is the market slowing down? Well, here is my main thesis why the economy is slowing down. It's because the global growth in the world is slowing down, and it's mostly because of the trade wars. As you can see by this illustration here, China represents 33% of global growth. USA is 11%. So most of the growth in the world is coming from Asia, specifically China. And when we slow them down, guess what? We're slowing down the whole world. And that's starting to show up in the PMI and the different leading indicators globally, and starting to show up here in the United States. And in May, one of the things that really got the market going in a downward motion was the fact that things broke down. I should say the trade talks broke down with China, and now we're even starting some fights with Mexico again. And so that has gotten the markets very anxious, and which is why we've seen this movement down in May. So to sum it up, the market is pretty fairly valued right now, but we need some sort of catalyst to get things moving up more, or at least to justify the prices that we've gotten to at this point. The economy is still pretty stable, but growth has slowed substantially, and the main reason is probably because of the trade wars. So if we could remove that main reason, I think we could do pretty well. If not, we might be continuing to kind of go through these volatile ups and downs, and maybe not end up much further than where we are right now. The Fed could cut rates, and that could be a good thing in the short term for the market, but I see it really as a bad thing long term, or even intermediate term, since they're not very confident the economy is going to recover. And having rates low for so long is not a good thing. And so finally, just playing it safe for over the summer. Sell in May and go away is an old saying. I don't necessarily believe in that, but this year might be one of those years, unless we get that catalyst sooner. But to say that we're going to have a trade deal with China over the summer is probably a little optimistic, but I hope to be proven wrong. So we're going to stay pretty neutral. We'll stay invested, but not overextend too far into the more aggressive areas of the market. So I hope you guys enjoyed the video, and tune in next month. Talk to you soon. Last thing, and very important thing, yesterday was D-Day. In fact, it was the 75th anniversary of D-Day. And I just wanted to mention it so that everybody will remember that freedom isn't free. It costs many of them the ultimate sacrifice. And so we just want to honor them, remember them, tell your kids about them, maybe watch a movie. But I just wanted to thank all our veterans, especially those from World War II. There's not that many of them around anymore that were so courageous during that time. God bless until we meet again.